I'm doing good, bro. Surviving. A lot of stuff happening, a lot of things going on in the macro field.
Hmm.
When you think the work is done, we see shit changing, like last week with the Taiwan dollar,
Yeah.
this week with Japan. A lot of stuff happening. How are you? What are you
Oh,
doing?
I'm doing pretty good. Yesterday was a big day for me. I had a crazy little trade that I had set up like a month ago or so. I did my research into that. I found some mispricings in the market, and then well, I executed on it. And yesterday it paid off big. So yeah, I'm doing pretty good.
What do you tell us? What do you tell the audience that you have done, like briefly, before we dive into macro? Like I know
Yeah,
you had an
so
arbitrage on a nano cap, but
yeah, it was so it came to my ears that there's a stock. They had quite an interesting story, which gave an arbitrage opportunity because there was a small stock. They were planning a so-called reverse merger with a private company, and the private company is doing this reverse merger in order to come get public through this nano stock company. They had a tiny market cap under 5 million or so. And the just the general overview in the merger agreement, there was a specification that anyone holding shares before the merger occurs will get at least 10%, or the overall shares will get at least 10% of the combined company. So there was an independent valuation into the private company. Obviously, it's a lot more difficult to evaluate a private company, especially for anyone from the public looking to invest. But just based on that valuation by an independent consulting firm, the market cap of this nano cap was too small in order to work together with this merger agreement. So therefore, I took a trade and I held it to where the market cap aligned with my calculations, where the fair value for this merge agreement was, and the market was simply mispricing. This could be to various reasons. I mean, it could be that it's such a small company that no one is looking at. Because if you really think about it, a market cap under a few million is nothing. It's a tiny nano cap. It's like a there's not a micro cap, it's not small caps, it's a nano cap. So firstly, I
exactly.
believe it was barely anybody looking at it, so therefore there was this mispricing, and then there was of course the risk that the merger will not be go through some regulatory hurdles and so on. Um, and now the merger has actually not completed, but the stock has started, or has actually yesterday and the day before traded into the range where I calculated the fair value of the market cap to be in alignment with the merger. So now I exited like 75% of my position, and the rest I'll be holding because on this merger agreement or on this private valuation, like this independent consulting company, in my opinion, for the business that this private company operates in, also kind of undervalued the company. But this now the last 25% of my position is kind of just a I can't lose on this anymore. It's just a trade to hold it to see how the market will price the company after the merger continues. So yeah, it's a really this is what I love about markets, about trading, because there's so many like different intricacies, so many small like weird things happening, and there's so many different stories, like every company has a different story. And with this one, yeah, it was really interesting to see and to figure out what was going on. I did my research in it, and then I held it. I believed in my research, and yeah, it paid off well. So yeah, I had a pretty good day yesterday.
So this is a prime example how professional shit is done, folks. You find something interesting before you buy, before you sell, you do your deep analysis, deep research, and then you manage your risk. Like as Torben said, he exited 75% of the position after it hits his target, and then now he is holding 25% for the dream in case this shit blows up like
In
another.
case we push
How many
another few
percent?
100%. Yeah, I'm up about 300-400%. That's where I
Same.
exited. So
By the way, this is not the regular things in the stock market, folks. So
No, you never see that shit.
it's
Yeah.
and this is what we try to chat about, what we talk. This is what we try to do here at STO is to find market inefficiencies or to spot trades at extremes. For example, the gold short at 3,500, the oil long after the OPEC announcement, or the short vola or VIX traded at 60. This is what we try to do, man, like spotting extremes or market inefficiencies and
And this
arbitrage
comes
that
hand in
shit, make
hand,
your money.
because
Yeah,
the market
exactly.
extremes are usually inefficient because they're
Yeah,
priced extremely to one direction, and that usually is wrong. Because as pretty much with everything in life, it's not an
exactly.
extreme. It's you kind of have the middle point is where it's correct. So yeah,
Exactly. But you gotta be extreme in your analysis, in your work, in your way of thinking to spot market extremes, to identify these extremes or inflection points where we trade at the left tail of the distribution or the right tail of the distribution. Yeah, congratulations, bro. How did you perform this year? Can you, if you want to tell the audience your performance this year, how much are you up year to date on the portfolio?
I mean, I checked
Not in
yesterday.
monetary, but give us percentage.
Yeah, yeah. I checked yesterday. I haven't checked today, but it's about like up 40% or so, 42. So I would say slight outperformance above the SPY. Slight
This is
outperformance.
not slight outperformance, bro. Congratulations. I love this shit. Uh, insane. Okay, perfect. Thanks for telling us
Yeah,
about this
quick little
opportunity.
story about the
Quick little
crazy,
story.
crazy things happening in markets. Yeah.
There's a lot of stuff happening, man. Like I start thinking Trump, he don't want to make America great again. He want to make macro great again. He want to make trading great again. This volatility, these opportunities are insane. It requires a lot of work, a lot of time to behind the screens, and you've got to be locked in like 16 hours a day doing research and thinking, calculating risk management. But there's a lot of stuff like QBTS, bro, these quantum.
Yeah.
It's trading today at
Crazy.
$20. It's insane. Like we started last after earning trade at 7, I
Holy.
remember.
Yeah.
Yes. So it's
I
going
man, oh
parabolic.
man.
It's a lot of stuff happening, even macro. So we're gonna start talking a little bit about Japan. And yesterday, if you saw this, um, actually it started on Friday. Let's start there. And we predicted this credit downgrade from Moody's
Hmm.
because S&P downgraded credit on the credit of the United States back in 2011, and then we got 2023 a downgrade from Fitch, and now we got the final one, which is Moody's downgrading the U.S. credit. And this has a lot of implications. Basically, the stock market didn't react on Monday as you would have expected. We got a gap down about 1%, then we got bought up back into the 595 level on the SPY. And then yesterday we got a gap down, traded a little bit lower sideways, and today we got also another gap down on equities. And this spiked the long end of the curve higher because the main reasons why Moody's downgraded the US credit is because of the unsustainable fiscal deficit. And here's the one question. Let me ask my traders. I don't think my traders even know it. So, what do you think the fiscal deficit of the United States is? We know it, it's 7%. But what do you think the fiscal deficit last year for Europe and Canada is and
Oh,
Japan?
no idea. But I would believe for Europe, especially Germany, it's going to be really low because no, Germany has always had this restrictive fiscal policy, or actually this how do you say it? But this more moderate fiscal policy where we have the whole thing about Schuldenbremse, which is the tax break, the not the tax, but the debt
Debt,
break.
debt
Yeah,
break.
where there's a limit to how much debt is being made. So I believe that, man, I have no idea. Maybe 2, 3% or so.
Exactly. Perfect.
Yeah,
2%.
yeah, yeah.
2%. even Canada 2%, and you got the US sitting at 7%. This is why we saw
Crazy.
this huge, insane pump in the US stock market. You got the country running a 7% deficit to GDP, while the rest of the world is running around 2 to 3% deficit, which is quite. We are
It's
talking about
because
euro.
it's
Yeah,
because I mean the US has been getting so comfortable as the having the reserve currency of the world. It's like, all
exactly.
right, we do whatever we want. We do our debt however we want. But yeah, it's insane.
Yeah. And now you got a complete change. Like the is wanting or willing to lower the deficit. And Besson talked about this multiple time on multiple interviews where he said, I want to lower the deficit to 3%. And you got another countries like Europe, especially Germany here, increasing the deficit. So you got a divergence again here in this economy. And if you trade FX, it's quite tough right now because usually in FX, there's two domains that dominate FX moves. First one is the interest rates differential, and the second one is cross flows. Cross flows usually is when we see capital rotating out of some assets into Europe or capital rotating out of Europe into other countries. And this is why you see the DAX hitting all-time high every single day, because you got a country that's willing to increase its fiscal spending, and the other country is willing to decrease its fiscal spending. And assets trade at the margin, which means like the rate of change in is completely diverging. One is going in the negative, the other is going in the positive. And this is why we see the European assets or European stock market booming lately. And for everyone who's talking about Europe is in a recession, I wouldn't say it's a recession, man, because it's not a typical recession behavior to see banks trading also at higher levels and hitting new all-time highs every single day. Like if you look at European stocks, it's have been booming.
Yeah.
Now I know we have
Especially like it started out with like defense industry where you saw Rheinmetall, RHM going crazy, where you saw the other producers of European defense going crazy. But the rest is really like if you look at SAP, Siemens, there's some crazy stuff. Like Siemens is kind of part of this AI story with factory automation, I believe. They do a lot of like yeah, automation work. So they are also contributing and benefiting from this AI story of this global thing. So yeah, they have been really going crazy.
you got Europe here, the ECB is cutting, they are stimulating the economy by cutting rates because cutting rates is stimulating. And you got another on the other side, the fiscal spending happening from the German government, like this $1 trillion bill, the euro bill, I mean, for 500 for infrastructure and another one for defense spending. And this is you got two trifecta, double effect, I'm gonna say, that's pushing asset prices higher. And this is why we see the euro, even though we were short the euro at 114, it played out perfectly for us, like 200, 300 pips, and we got out. We see the euro holding at these resilient levels because the market is not looking at interest rates differential. It's looking at the growth story around the globe. And now it's time for the US to take the back seat. So now let's touch a little bit about Japan because the main thing I wanted to talk about is Japan. And if you look at it, we had yesterday a huge spike up in the 30-year yield, 1 year yield, and the 40-year yield in Japan, which means that the Japanese bonds got absolutely cooked. And this happened because of a failed bond auction, the 20-year bond auction in Japan. And by the way, before I start talking about this in depth, I would also mention this. If you look at today's 20-year bond auction in the US, it's one of the most important bond auction that you will see because Japan yesterday, this failed auction or this bad auction that we saw, let me rephrase it. It's actually a bad auction. It didn't fail. It was a bad auction. If this transmit itself into the United States, oh boy, the S&P is gonna get cooked today, and the TLT, the long end of the curve, is gonna get cooked. And by the way, we are trading now. It's 11 in the morning. we are trading at 5% on the 30 year. So we could see
which
new
is
highs.
crazy high.
Yeah, we could see
And if
another
you look at the 10
2% there.
year, 10 year also
Oh,
4.5%,
exactly.
4.54. So
Yeah. So we could see if we see a failed auction today, we could see yields up like 6%, which is gonna be like 12 basis points, 13 basis points, 14 basis points. Um, Shit's gonna get cooked. So now
yeah.
let's move let's move to Japan because this is important. I explained why yields jumped that high yesterday. So now let's talk about the market implications. What can we do in this situation? Basically, the BOJ stopped buying bonds, so they started their tapering process in Japan, which is quite problematic for the Japanese bond market because the BOJ owns more than 50% of the debt, and the debt to GDP in Japan is around 240%. So who owns the majority of the debt? The BOJ. And if they slow the pace of buying, here's what people don't understand when it comes to monetary plumbing. QT or QE, it's not about buying, it's about the pace, the speed, the rate of change. If you slow down the pace of buying, what you're actually doing is the following. You're letting liquidity, if you do QT, if you accelerate the pace of selling or the pace of runoffs, you are draining liquidity out of the system, which means you are removing liquidity on a slower pace. And this is why we see sometimes that yield drifts higher. And on the other side, the same if you do yield curve control or quantitative easing, if you slow down the pace of buying, the amount of liquidity that's flowing into the economy is getting less and less and less. Another example is if you have a pool and you open like the water and you start filling the pool. At some point, if you reduce the water pressure that's coming into the pool, it's going to take longer for the pool to fill up. And this is how you can think about liquidity in these markets. And this is important for equities, for especially for the carry trade, because we know Japan is a carry trade. The yen is a carry trade currency, and this has huge implications. Now, the dilemma is going to be there if the Japanese banks starts also dumping or letting their Japanese bond matures and not reinvesting that capital, because this is going to send yields at higher levels. Not forgetting the inflation problem that they have in Japan, where we saw the last reading coming at around 3%. And the BOJ wants to hike rates, but they can't because of the debt that they own. Because this, if they hike rates on the short end, this will also accelerate the move on the longer end. And then all of a sudden, you're going to see 30-year Japanese bonds trading at 4%. And it's not good. It's like, I haven't seen this in my entire trading career, bro. Like my entire career in macro, Japanese yen, like, let me check for you guys. Let me see how we're trading at levels. Oh, I gotta go on the monthly chart to see this. We are trading at levels like never seen since 2007, 2008,
Oh,
which is quite like the 30-year Japanese yen used to trade under 1% for almost a from 2015 to 2022, 23. We traded around 1%, below 1%, and now we are talking about 3.1%. 3.1%. It's the
that's
same as
crazy.
if you like it's if you look at the German 30-year bond, we are trading at 3.1%. The German, and we don't run a huge fiscal deficit here in Germany. Problem is also going to be if oil starts pushing up because the Japanese imports 90% of their oil. And then you can imagine what's going to happen. You're going to see maybe we could see another episode of the carry trade unwind, and the trigger is going to be breaking below 141 on the end.
So if oil prices go up, which will mean inflation in Japan will go up because they have to import their energy, they have to import their oil, and then the BOJ will have to hike the rates in order
Yeah.
to
There's
work against
exactly there's
inflation and so on.
two ways for the BOJ to come out of this. Either they hike rates
Hmm.
and they're going to increase the cost of capital, aka the yields on the yield curve in Japan going to spike up higher, and this is not going to be good at all for Japan debt because it's also like a bubble that's going to burst. Everyone's talking about, oh, Japan has been for the last 20, 30 years, for the last 2 decades. It's okay, they have higher debt, but the debt is held in hometown. It's nothing too big to worry about. The BOJ controls the majority. Yeah, exactly. But we had deflationary regime. Now we are going into reinflation regime. And this is the problem. It's complete macro shift that we are going through right now. So if the inflation problem sticks and we see inflation picking up back to 4.5, 5% in Japan, which could be due to rising in oil prices and a weaker yen, because the yen is, where are we right now? 144, 145. Quite tough for them. A weaker yen would mean more inflation. A stronger yen would mean less inflation or disinflation because they can buy cheaper oil if the yen appreciates against the dollar because oil is trading in US dollars. So it's quite interesting to see. I think the Nikkei could trade higher, man. We have been trading in this range for almost like one year. We could see all-time highs on the Nikkei at 42,000. It might take long time to get there.
Yeah, interesting.
Yeah,
Crazy. Crazy stuff.
it's a lot of things happening, man. Like you can trade FX. By the way, I think FX is the best asset to trade this year because we saw the volatility spike in equities, we saw the volatility spike in bonds, and we need volatility spike in FX. We need it. It's the last asset to spike. We saw volatility spike in gold, we saw volatility spike in oil, and the last one to see is gonna be FX. So this is where I'm focusing right now. But you gotta figure out the pairs to trade, bro. Like
And you got to be
everything,
ready for what's coming. You got to know what's going to
exactly.
come. Yeah.
Because every single day there's a lot of stuff changing. Japan last week, well, Taiwan dollar. Next week,
Hmm.
maybe the Swiss franc. I don't know. Um, but you gotta have a big or good understanding of monetary policy and how it impacts FX movements. Understand also the narrative because we have been fluctuating between interest rates differential between the ECB, for example, and the Fed, or the BOJ and the Fed, and back to this narrative of okay, no one wants to own any US assets because the US is not good, and we saw these cross flows getting out. And this is why it's also important to understand FX in relationship to equities. If you look at
Yeah,
this,
what means this and that for the dollar
exactly,
or yeah.
exactly. When we see the dollar trading lower, we see also like weakness or equities stopping instead of pushing new highs on the SPY. Like today, the dollar is down, SPY is down in the pre-market. Yesterday, the dollar went down and equity rally stopped. Like we traded sideways, even red on the day. Uh, this could also mean that capital is leaving the United States. And another thing is the following. If yields in Japan shoot up that high, as a Japanese investor, you would ask yourself, why would I even invest in global bonds if Japan, aka my hometown, home country, offers me the same returns? So this would put also upside pressure on the yen. You will see the yen is getting stronger because we could see Japanese investors rotating out their capital back into Japan. to take advantage of the bonds, but also maybe take advantage of the move in the Nikkei. Problem is the 30-year bond is now right now trading at the same level of inflation, which is like on a real term, on a real basis, you are not making anything. So I think at the margin, at some point, the Japanese bond's gonna get interesting, sorry, if we see them trading at 3.54% above the rate of inflation.
Which is an
Uh,
extreme as well.
yeah, this is also what I'm waiting for as a signal. If I see that the Japanese bonds trade yield trading at a higher pace of the inflation rate, this is a signal for me for a trade in the yen. I'm not gonna mention which
Hmm.
direction, long or short, because I need more clarity, more time. But this is what I'm looking at for a signal to be interested more in the Japanese yen to take a big position for a long or a short trade, depending
The
on the
legendary
narrative.
yen long.
Bro, the legendary yen long was last summer where we shorted these 160, 161 on the USD GPY because I had this thesis on the unwind of the carry trade. And I was, to be fair, I took three times I got hit on this at 155, at 160, and 156. And then the last time it worked out and it paid off. Like I was able to get it from 161 short to 142. I captured this entire move. And then all of a sudden I realized everyone was a yen carry trade expert on social media. And then I said to myself, okay, you know what? It's time to exit this motherfucker.
Yeah,
Made some good money, some extremely good money. It was like one of the biggest trades in my career. And yeah. Any
not bad, not
any que-
bad. Not
any question
no.
any question on
I
macro?
Man, it's complex. It's complex, but no, so far I'm good.
You you gotta dive. The problem is macro on the surface right now. If you look just on the data itself, it's it's not gonna tell you anything. And this is why the newer guys with us at the firm at STO, the macro traders, they have a lot of problems. A lot of problems. They can't understand what's going on. They can't read between the lines because on the surface, it's like you got this divergence between the hard data and the soft data. You gotta dive deep, very deep into every announcement, into the fiscal side, and then construct any trades or understand what's going on. Now it's the time to show who really got skill and who is the guy like who made his money or made her money
Who
just by
he made
buying.
money when everybody was making money.
Yeah. So
Yeah, but this the interesting part about equities. It feels like we are going to get, especially in the US, we're getting back into this, oh, no matter what, we just buy everything because now people are like, oh, tariffs are gone, everything is fine again. We're back to 2024. It feels like it's that kind of sentiment, even though it doesn't make sense because there's something cooking, like there is something boiling beneath in the clogging of this whole monetary system with macro with FX. So it feels like this is the wrong sentiment, but to be honest, you can always say that, and then in the end, it's only the people who are dumb and just buy whatever who are making money. So yeah, it's difficult to navigate this kind of thing again. But as always, it's always difficult. Nobody knows what's going on, especially not people who manage money. But we are still trying our best.
we try to figure out like this is why sometimes when times are difficult, we reduce the size of our bets
Yeah.
and we try to do risk
You
management.
gotta, if it gets really tough, gotta survive. And then
Exactly.
the moment you get some clarity, the moment you figure out stuff, this
Exactly.
is where you go big again. This is where you start, all right, now we have some direction, now we know where we're going, and then let's go.
And this is also the slogan or AKA the motto we use here in our trading. You gotta survive the times of uncertainty and get back with leverage in
Yeah.
times with when there's clarity. For me, like I was long the EWJ. because European equities are quite more interesting. Looking at this fiscal divergence we see from 36 to 39, I sold some calls, and man, I'm looking at it now. I'm trading
EWJ,
around
you mean EWG or
AWG, Germany. Sorry.
yeah, yeah, yeah.
Yeah. And I think I'm gonna roll up these calls like towards the 45, something like this, 44, 43, because the DAX is hitting new all-time highs every single day,
Yeah.
bro.
Yeah. It's
What's going on
insane.
with on your side in your department?
Well, to be fair, the question now is about, all right, what's going on with the US consumer markets? We've been getting the reports of Walmart, Pepsi, and Coca-Cola. So I they the well, quick rundown, Walmart. So they have been saying, all right, we can't ourselves tank or we can't ourselves absorb the price increases by tariffs, which is like, if you think about it, it's really, really bad because Walmart, the biggest retailer of them all, who has the biggest pricing power in terms of negotiating with the suppliers, saying like, all right, we are your biggest customer. Like this is no, if Walmart negotiates with the suppliers, it's saying like, all right, we're your biggest customers. We know the tariffs are coming, so make us this and that product maybe 5% cheaper or so, or maybe give us 2% and we take the other 3%. But they are saying it's not possible for them to fully absorb these tariffs. Therefore, they will have to pass the price increases on to the consumer. And if a Walmart, who has so much leverage over the suppliers, is already saying, all right, it's looking tough, then the other retailers will also have big problems. And this could lead to an increase in inflation, increase in prices, increases in or a hike in prices. This is one side. This is what is really not looking good from their report, from their earnings call, what they were talking about. This is no, you got the whole beef. Trump after the earnings call, I believe it was Trump or maybe Levitt, the spokesperson for the White House or so. They said, "All right, Walmart, man up, eat the tariffs," something like that. Um, but this is the bad part. But on the other hand, it's also they've been giving quite good news because they have been saying, all right, sentiment is bad, but the consumer is still doing well, still spending. There has been no significant shift in consumer behavior or in their spending behaviors. So therefore, it is it is still the story of, all right, when will we actually get the move towards the hard data? When will we get the shift towards where the sentiment turns over and really makes the actual hard data, the consumer behavior, the consumer spending, how where when does it have an effect on that? So, yeah, and then looking at the Coca-Cola earnings, it was also quite a similar story. They were saying, all right, sentiment is here. We're really, really bad, but the consumer spending is still here. They're still doing fine. They still had an increase. They still had like solid spending. And so, yeah, to be honest, this is kind of the story that's going on. It's kind of unclear. If you look at the stocks, how they're performing, we're still pushing. Yes, Walmart is not at these all-time highs where we were towards like the beginning of the year or so, but we're still we made up everything of the April 2nd losses. Also in the XLP, we've also pushed back like in the consumer staples and the staples ETF, we pushed back right to where we were in the ETF after the announcement. So it is difficult. I will be looking for. I'm waiting for more earnings because tonight or today we'll be getting the Target earnings, which is also interesting. I'll be waiting for Ross, I believe. Ross stores, they will be reporting as well. Yeah, towards the end of the week, they're rallying big into these earnings. but towards the end of the week they will be reporting as well. So to be honest, I kind of have to wait. Uh, yeah. So
This is why this is here I would say this. Don't look at the wording of someone, look at their action. And
yeah.
this is why like the consumer sentiment is completely destroyed, but look at the action. It's looking good.
Yeah, well, we've got to wrap it up here pretty quickly. So I hope everybody enjoyed. I hope everybody found it informative, and I hope you have a successful trading week, successful trading year, some good performance. And with that being said, uh, see you around. See you the next one.